experience, among other things, I can then make a decision the next day whether I still want to enter into this position. Now, again, with a number of the different currency pairs today, we're going to experience further volatility. So we've got the U.S.-Japan currency pair. We can see that U.S.-Japan has moved lower. Now the thing here is, when this trade moves lower like this, do we want to panic and exit the trade? Absolutely not. We want to wait for this thing to pull back. In this particular case, looking at the U.S.-Japan currency pair, it's pulled against us by about 40 pips. That's not a big deal. In your short-term intraday trading, where you're loading up with say for example, we've got $50,000 in this trade. We do a $2 million trade and we have $50,000 in our account. Well, chances are you're not going to actually sleep too well if you're doing that. But here, I'm only down $215 on a $44,000 account. So in this particular case, I can put my stop loss. I'm going to enter this so everybody can see this, and I'm going to put my stop loss down around the 93.20, below that 18-day predicted moving average from VantagePoint. When it gets down here to this level, so I put a stop in there, I'm safe. I've calculated that out based on a percentage of the account where I'm going to put that stop. But a 30-point stop or a 50-point stop in Forex, guys, completely unrealistic. Completely unrealistic. This market does 50 pips before it even has its coffee in the morning. So if you're going to go in there using very, very short-term indicators and try and scalp 20 or 30 points, you want to be very, very cautious doing that. You're better off to average positions out. Like in this particular case here, the market's gone against me by 40 pips. I think it's still going to go higher. Now, we've talked about looking at the Vantage Point. Let's do a quick analysis against the U.S.-Japan again, because we're in this trade, and it's nice to have one that goes against us, because then we can actually take the opportunity and look at it and say, well, what do we do with this? Well, we've identified that 93.59, 94.02, and 94.35. So 94.35 is identified is somewhat of a critical level. So, I don't have to add another $50,000 position here. I can add maybe another $20,000 position. Now we have a buy position at 94.76 and a smaller buy position at 94.38. So I don't need to load up a whole another $50,000 or $100,000 and try and make back what I've lost. What I'm doing is identifying a key area between 93.59 and 94.35, and I can scatter positions, smaller positions, in between this area, and then when it moves back to a major support level that I've identified using the VantagePoint software, I can then use that to actually get a better price on my trade. Now, another beauty of using the FXCM UK platform, and I'm sure you guys that are watching this, you already have overseas platforms. There's no first in and first out rule here. I can enter as many positions as I want, whether in the buy or sell. I can exit the positions. I don't have to exit this position first. So I have a great deal of flexibility by doing that. Hopefully the NFA will learn, the mistakes they're making, and they will change some of these rules, because this is a better way to trade. So I bought at 94.76. I bought at 94.38. Now I'm going to sit tight. I'm going to let this thing pull back, see if it moves back under 94, and when it does, maybe I'll add one more. And then I've got 3 positions scattered in the overall range, and then I can put my stops below that area. So there's a number of different ways, again, that this can be played out. Now, our U.S.-Canada trade, very aggressively moving higher. We're into 657, 657. Australia-U.S., New Zealand-U.S., kind of sitting around this area. We've hit 71.41. But again, we've identified for the day, it's gone up to 72.21. When it's gone up to that area, that represents a good selling opportunity. But again, we have to be careful, because the only real indicator we have on this trade is that short-term crossover. But we've got these other indicators that are getting ready to roll over, but they're not really putting out a sell position on New Zealand US just yet. And again, that's why I'm using that to demonstrate here that this is a very good possibility that this New Zealand US trade here could go against us, which it's actually doing right now, because the trade was based only on a short-term crossover. So again, we want to be careful of that, but also the short-term crossover, to clarify, can be a very, very good indicator of a very short-term corrective move, but I wouldn't say it would ever be used for a trend reversal. That's just unrealistic. So That pretty much concludes the presentation for this morning. We've got some trades we're looking at. Again, we want to look at the US-Canada buy on dips, the US-Japan for today. I think we're safe to go ahead and buy all the way down to that 93.59, 93.60 area. Any pullback in that represents a good buying opportunity. I think the downside is going to be very, very limited on that today. Now, when we're getting into huge market moves like this, like Euro-US, you know, it was just at 133 a couple of days ago, guys. The probability of a whipsaw here can be very, very high. So we want to remember to take that into consideration when getting too aggressive, like selling Euro-US at these levels. We're at 9:48 a.m. Eastern Standard Time. Remember, this is the end of the trading day in Forex. It is not the beginning of the trading day. So a lot of these guys, they're going home, they're closing out positions. So it could, you know, if somebody's in a short position from last night on Euro-US, for example, and they close that out, that could artificially weaken the US dollar if enough people close those positions, and that'll push Euro-US higher. So just, you know, things to keep in mind. So what we're going to do here now is we're going to go ahead and we're going to take some questions on the presentation if ever anybody has any. And again, you know, we're looking at a very volatile morning, that's for sure. But again, with that volatility, there's definitely some good opportunity. But you know, we want to be careful and always look at the bigger picture here. We don't want to get into too short term of trading, because if we do, you know, especially under short-term trading and short-term indicators can be very good, you know, when you have more stable markets, let's just say that. But under these current conditions and the conditions really that we've had for the last couple of years, you know, we want to be very careful. So question here from Patrick, do you just trade US dollar pairs? Great question. Absolutely not. I trade anything that is tradable, Patrick. So essentially what I'm looking at doing is, you know, Patrick, the cross pairs represent some very, very good opportunity. But just remember, when you're trading those cross pairs, they are still based around the US dollar. For a cross pair to be traded, the US dollar has to be traded first. Now, an example of that is US Swiss franc. US Swiss franc is actually not a major. It's made up of Euro US and Euro Swiss franc. So before US Swiss franc can be traded, those other two pairs have to be traded first. Same thing would apply to for something, for example, Australia, New Zealand. Before Australia, New Zealand can be traded, Australia US and New Zealand US has to be traded first. That's why you see that wider spread. But on other pairs like Euro Great Britain, Euro Swiss franc, the spreads are very, very good. Another question from Patrick. Do you trade Japan? It seems to be breaking the 18-day EMA a lot. Well, you know what, Patrick? If we go back and look at that chart, it's actually hasn't broke it that much. You know, it's actually held above that 18-day predicted moving average for some time. So let's actually take a second here and go back and have a look at that question just to help Patrick out here. We're going to go back just to have a look at this for one moment, and we're going to put that up with the, let's go here, pairs. So what we're going to do here, Patrick, so you can see this, I'm going to pull this back here. Now, if we have a look at this, Patrick, if we're looking at this from the beginning of April, this is, we're coming back, we've hit this 18-day predicted moving average 1, 2, 3 times, but each time, Patrick, this is